This is the final video presentation out of 2 on the weighted average cost of capital. In this presentation, we're going to talk about briefly the relationship between financial leverage and the cost of equity. The key point is that taking on debt increases the risk to shareholders. Regardless of whether you think the capital asset pricing model or some other equation is a useful way to estimate the cost of capital, the more debt you put into a business, the more risk exposure there is for the shareholders. And this doesn't just mean the risk that the company might default and the assets end up in the hands of the lenders. It means that there is more week to week, month to month and year to year variation in the returns to shareholders because the lenders have a fixed claim on the assets of the business and the cash flows of the business. In short, the lenders have to get paid first. So the more debt you put in the business, the bigger the claim the lenders have, whether it's assets or cash flows, and the equity holders are the residual claimant on those assets or cash flows. The bigger the slice of assets or cash flows which flow to the lenders, the smaller is the fraction which is left over for shareholders. And if things go really well for the business, so cash flows are high or asset values are high, that slice will be large. If things go poorly for the business, that slice will be low. And the more you increase that first chunk which is flowing to the lenders, the more volatile will be the cash flows or the asset value flowing to the equity holders. Now we're going to illustrate that in much more detail in percentage terms, in terms of payoffs and earnings per share in some presentations coming up on capital structure. But I'm going to introduce it here as an introductory equation to show the relationship between the cost of equity for a firm without debt versus the cost of equity for a firm with debt and how that fluctuates with changes in the debt versus equity mix. If the leverage ratio is constant over time, that means if the percentage of the finance provided by debt versus equity remains constant every single year, our equation says that the cost of equity of a firm with debt is equal to the cost of equity of a firm without debt plus a premium for bearing financial risk. And that premium can be computed as the cost of equity of a firm without debt minus the cost of debt times the debt to equity ratio. So let me explain that equation in more detail. This first term in the equation, the cost of equity of a firm without debt, that's a baseline. That's an estimate of what a fair return would be to the shareholders in the business if the business didn't take on any debt. It is what we call unlevered. Now the moment the firm takes on some debt, the risk to the shareholders goes up, and we want to add into a premium to that required discount rate for taking on that financial risk. So the second term represents that incremental return associated with that financial risk. And it's given by the gap between the cost of equity of a firm without debt and the cost of debt times the debt to equity ratio. And I'll take you through a couple of examples in a moment. So suppose you wanted to analyse, well, how would your cost of equity change for a firm as you had different amounts of debt versus equity? The first thing you have to do is come up with the baseline, the cost of equity of a firm without debt. The second thing you have to do is come up with an estimate of the cost of debt. And then you have to see how that cost of equity is going to shift as you shift debt to equity mix from debt 10% to 90% to 20-80 to 30-70 and so on. Now take careful note that the ratio in this equation is the debt to equity ratio. In our weighted average cost of capital, we've got a ratio of debt to debt plus equity. That was the weight placed on debt that went into our weighted average cost of capital. If I go back a few slides, you can see that our equation for the weighted average cost of capital is cost of equity times the proportion of equity plus the cost of debt times 1 minus the corporate tax rate times the proportion of debt. So what you see in this box is the debt to debt plus equity ratio. But when we're considering this particular equation, how the cost of equity is going to change as you put more financial risk into the business, the ratio in this equation is the debt to equity ratio. This could be arranged to give us the cost of equity of a firm without debt. So I can measure the cost of equity for those mining firms we looked at previously, and if I want to know what would be my cost of equity of a firm if it didn't have any debt, I would estimate the cost of equity for the mining company. I would use that estimate of the cost of equity of a firm with debt, because BHP, for example, has debt, in this equation with BHP's cost of debt and debt to equity ratio to estimate what would be my proxy if BHP had no debt. And then I could use that proxy in some subsequent analysis. Now we can only understand this with an example and some computations, so let's do this. The question is, suppose you wanted to know what the cost of capital would be for a project or a company if it was financed without any debt. Now what we can observe is these returns for these listed companies. I can observe equity beta estimates for these companies that do have debt. I can't directly observe what their cost of capital would be if these companies had no debt. They do have debt, so I've got to unravel their cost of equity. So I would say for BHP, its cost of equity with debt, because I know BHP has some debt, is estimated at 13%. I came up with that number as a 2.5% risk-free rate plus a beta estimate of 1.5 times a market risk premium of 7%, giving me 13%. I can estimate the cost of debt for BHP with reference to its credit rating. BHP, when I did the numbers, had an A- credit rating, A+ credit rating, and a data provider estimates that firms that have an A+ credit rating from a ratings agency, they typically have a cost of debt based upon the yield to maturity of their corporate bonds of 3.3%. So I could say, based upon BHP's cost of equity and its cost of debt and its debt to equity ratio, that if BHP didn't have any debt, so we strip out the impact of financial risk on the cost of equity, the cost of equity would decline to 11.38% from 13%. So you would say the cost of equity for BHP is comprised of two parts. The first part is a baseline, the cost of equity if BHP didn't have any debt. The second part is an incremental return for bearing financial risk. And that incremental return based upon our equation is 1.62%. The difference between the 13% cost of equity and the 11.38% cost of debt. If I repeat those computations for all 5 comparable firms in my sample, I could say that on average, the cost of equity of these businesses without any debt is equal to 11.54%. The lowest estimate is 9.25% and the highest estimate is 11.69%. Now remember, because of estimation error, I don't want to place any particular emphasis on the cost of equity estimates for any individual company. Those are greatly distorted by noise in those beta computations. I only want to draw conclusions from summary statistics like the median or the average because I'm trying to mitigate estimation error. So I don't want to say to someone, well, BHP's got a cost of equity of 13%, whereas the cost of equity for Vale is much lower at 10%, and the cost of equity for Glencore is much higher at 16%. That stuff just isn't true because of noise in the data. But what I can say is that the typical cost of equity for a mining company is 13%, and the typical mining company cost of equity, if it didn't take on any debt, is 11.54%. I'm basically saying that these firms are representative of mining companies, but I don't know definitively how to measure the difference in their particular cost of capital because of noise in the data. So, as I say on this slide, the implication is that if a mining company was financed without debt, its cost of equity would be at estimated 11.54%, and its weighted average cost of capital would be 11.54%. In that instance, the weighted average cost of capital has to be the same as the cost of equity capital, because that was an estimate of what the cost of equity capital would be if there was zero debt. There's no weighting to be had, it's 100% equity financed. You could use that figure as a baseline for a mining project and then increase the cost of equity as leverage increases. So take the following example. Suppose you decide that this mining project should be financed with 40% debt and 60% equity and borrow money at 7%. It's a pretty high borrowing rate because that's a fairly high proportion of debt for a mining company or a mining project. Question is, what is the weighted average cost of capital? Well, the first thing that I would do is estimate the cost of equity with debt, because now we're going to incorporate the 40-60 debt to equity ratio. We would say that the cost of equity with debt is the cost of equity without debt minus the cost of debt times the debt to equity ratio. And putting numbers into that equation, that would give us a cost of equity capital of 14.56%. The baseline cost of equity without any debt is 11.54%. There's another 3.02% premium for exposure to financial risk to the shareholders. The cost of debt is 7%. The corporate tax rate I'm going to assume is 21%. And then I can compute my weighted average cost of capital using the 14.56% cost of equity, the 60 versus 40% debt equity to debt ratio, a 7% cost of debt, and a 21% corporate tax rate. That gives me a 10.95% weighted average cost of capital, and I can apply those to my free cash flows that we defined earlier to value that particular project. We've worked through the equations on the left-hand side. These are general equations that work for any way you want to estimate the cost of equity. I mentioned a couple of other models before, the Black capital asset pricing model and the Farmer and French 3-factor model and the Farmer and French 5-factor model. But you could also have a model that says, well, I just think small firms are riskier than large firms. And there's some evidence that that's true. And you could say small firms have a discount rate of 12%, large firms have a discount rate of 9%. That's a model. Right? There's different ways you can think about discount rates. You could say that large listed companies have a discount rate of 9%. Large unlisted companies, because of a lack of liquidity, have a discount rate of 11%. That's a model. There's a huge number of ways you can think about discount rates. And the equations that you see on the left-hand side are general equations that work for any way you want to estimate the cost of equity, including one particular way, the capital asset pricing model. But often you will encounter some specific equations on the right-hand side that work only if you want to use the capital asset pricing model to estimate discount rates, despite its limitations, that it's biased, imprecise, and incomplete. And those equations are as follows. We can convert the returns that you see on the left-hand side to beta equivalents. As I was saying, we can convert those return estimates into beta equivalents using the capital asset pricing model. And so we have equations on the right-hand side which only apply if you are in fact going to use that capital asset pricing model. So the equations say equity beta equals asset beta plus asset beta minus debt beta times the debt to equity ratio. What that means is that there is a baseline estimate for beta, the asset beta, plus there's going to be an increment or a premium incorporated into the equity beta for bearing exposure to financial risk, which is asset beta minus debt beta times the debt to equity ratio. There's a corresponding equation for the cost of equity of a firm without debt, which is asset beta equals equity beta plus debt beta times the debt to equity ratio divided by 1 plus the debt to equity ratio. And I'm going to work you through a couple of examples applying these equations as well. I do not want anyone to apply the following equation in their computations. The following equation is based upon assumptions which in general don't apply throughout the rest of your financial modelling when you're using the free cash flow to the firm approach. It's very commonly used by bankers, but it embeds some assumptions that are clearly inconsistent with all of the other estimates that they're putting into their spreadsheet. Now, it's an issue that we cover in more detail in corporate investment decisions, but if you use this equation, you'll be making computational errors in your modelling, and that could materially distort your valuation. The equations that we have here on the left-hand side and on the right-hand side, they are going to be the correct equations to be consistent with all of your other modelling. So don't do this. Don't write asset beta equals equity beta divided by 1 plus the debt to equity ratio divided by 1 minus the corporate tax rate. If you use that, you'll be making a computational error. By the same analogy, don't use equity beta equals asset beta multiplied by 1 plus the debt to equity ratio divided by 1 minus the corporate tax rate. And I will tell you specifically why not to use those equations. First of all, the underlying theory which justifies those equations, the underlying assumption, is that the cost of debt is equal to the risk-free rate for the corporation. And that assumption isn't true. The cost of debt is some premium above the risk-free rate for default risk. Secondly, inconsistent with this equation here, the assumption is that over time the firm borrows an amount of money in dollar terms and it keeps that same amount of debt every single year in perpetuity. Whereas in reality, or inconsistent with all of your other modelling and in the weighted average cost of capital, you will typically be assuming that this proportion of debt versus equity, say this proportion of, in our previous example, 18% as the debt to equity ratio, typically throughout all of your modelling you will be assuming that that fraction remains constant over time. That is what has gone into the weighted average cost of capital here. That proportion is remaining constant. So in short, this equation that is typically used by bankers to estimate asset beta or equity beta is inconsistent with all of the other assumptions in their spreadsheet in two ways. It embeds an assumption that the borrowing rate is equal to the risk-free rate, but elsewhere in the spreadsheet, bankers correctly put in the corporate borrowing rate. Secondly, it embeds an assumption that the percentage of debt versus equity doesn't remain constant over time. These equations on the screen embed the assumption that the corporation borrows a given amount of debt in dollar terms, and that dollar terms number stays constant forever. Whereas everywhere else in the spreadsheet, via the weighted average cost of capital, the banker has assumed that the percentage of debt stays constant over time. And as the firm grows, then the dollars amount of debt will increase. And that's where the computational errors lie. Use the equations that I've presented to you because they're simply consistent with all of the other assumptions within the same valuation spreadsheet. Let me take you through an example where we're going to estimate the cost of equity for each mine without debt by estimating asset betas and then applying the capital asset pricing model. And you'll see the answers end up being the same. Recall that we have for BHP an equity beta of 1.5. The cost of debt was 3.3%. The debt to equity ratio was 0.2 based upon the amount of debt versus market capitalisation for BHP. The debt beta in our computation is going to be 0.11. Where do I get the debt beta from? The debt beta is going to be the cost of debt minus the risk-free rate divided by the market risk premium. That's just rearranging the capital asset pricing model. The capital asset pricing model if applied to debt, says that the cost of debt is equal to the risk-free rate plus the debt beta times the market risk premium. So if I rearrange that equation for debt beta, I'm going to get cost of debt minus risk-free rate divided by the market risk premium, which for BHP is 0.11. To get the asset beta, I apply this equation, equity beta plus debt beta times the debt to equity ratio divided by 1 plus the debt to equity ratio, and the asset beta turns out to be 1.27 in the BHP case. And then I can estimate the cost of equity of BHP without any debt as the risk-free rate plus the asset beta times the market risk premium, which is 11.38%. The key point is that if I estimate the cost of equity for BHP without any debt, I get 11.38%, regardless of whether I take the asset beta, equity beta and debt beta route, assuming the capital asset pricing model holds, or I just take the general route that says the cost of equity of a firm without debt equals the cost of equity of a firm without debt plus some premium for bearing that financial risk. I get the same answer using both approaches. Finally, you don't need to use the capital asset pricing model, but there's no circumstance in which the approaches on the right of this slide actually save you any time. Now I present it to you because someone else might ask you to compute asset beta. There might be a relevant metric for someone. They might ask you to do it, so I should show it to you. It would be unreasonable for me to not mention asset beta. But it actually doesn't reveal any information. Right? The question is, what would be my cost of equity if I had some debt or I didn't have any debt? And that's going to be important because as we change leverage assumptions, that's going to change the risk to the shareholders and therefore change the discount rate. But we don't need the asset beta itself. We've already done the computations without the asset beta and it doesn't save us any steps. So we don't need that particular equation. And crucially, don't assume the beta of debt equals 0. Some people will say the beta of debt should be 0 because, well, debt doesn't really have much systematic risk. And the capital asset pricing model says ignore all the other risks. But that's not what's in our spreadsheets. What's in our spreadsheets when we do valuation is an assumption that the cost of debt is a fair return for the lender's exposure to risk. We do all our modelling as a scenario, as a proxy for the expected outcome, and we assume we're going to pay the lenders back in that scenario. So even though it's true that debt doesn't have a huge amount of systematic risk is quite low for debt, the fact is that we are using the yield to maturity on corporate bonds as our proxy for the cost of debt. That's flown through to all of our other modelling. And if you want to go down the route of incorporating the capital asset pricing model to come up with an asset beta, you've got to come up with a debt beta that's consistent with all of your other thinking, all of your other assumptions about debt in your analysis. So you've got to use the equation that debt beta is cost of debt minus risk-free rate divided by market risk premium. If you assume the debt beta is 0, you're just going to have an error in your computations that is completely unnecessary. It doesn't save you any time, doesn't save you any resources. You will assume the cost of debt includes risk in your weighted average cost of capital, so you should assume the cost of debt includes risk in estimating the asset beta. You can't have that inconsistency or you will make a valuation error for no particular reason. That is our conclusion on this introduction to estimating the weighted average cost of capital. I hope those examples were useful. Next up, market efficiency. I look forward to that discussion.